So one of the reasons I do not like really getting into general property advice is because there's just no such thing, right? There's general market conditions, but there are no general portfolios. Every single investor, comes to us with such unique circumstances. They've all got a very different story about why they're actually doing what they're trying to achieve. They have different assets inside their portfolio. They have different debt structure, and they have very different incomes, PAYG, self-employed, short-term employment, and very, very, very different objectives around why they're even trying to do what they want to do. So I guess rather than trying to answer, what investors should do, I'd much rather be asking what investors should be talking about, because ultimately that's where the better decisions, begin. So let's imagine, somebody living in Brisbane. They already own 2 investment properties. They're both well located, and both have ultimately performed really, really well over the last sort of 5 or 6 years. Both continue to experience, strong tenant demand, but they read the headlines. There's a correction, and immediately they start to wonder, whether or not they should actually stop growing their portfolio. Well, honestly, the answer is probably not. But the more interesting question is whether or not their current lending structure actually allows them to take advantage of the environment that they're already in. Because sometimes, the limiting factor is actually not the equity, it's the borrowing capacity, it's the structure that they might have set up within their portfolio, and it's the flexibility, or ultimately the lack of flexibility, that enables them to be able to move forward.
Yeah, the market data alone does not determine whether another acquisition is appropriate. The investor's debt profile and cash flow, their future borrowing capacity all become part of the investment decision. And that is why 2 investors in the same suburb can reach completely 2 different conditions or 2 different conclusions using the same market evidence.
Yeah, look, exactly. And sometimes the next property is not really the conversation, is it? Sometimes it's the next lending review or the debt structure that needs to be fixed, right? So, let's imagine someone completely different, right? They've gone out, they've built wealth inside Sydney, they've maybe built out, a large property investment portfolio, maybe blue chip investments. And they've done well, maybe over many years, right? But now they're actually looking north, right? They're having a look at Queensland as a bit of an opportunity. And, the temptation is to compare headlines, right? Sydney is slowing down, but Brisbane is growing. Simple, for most people when they see this as an opportunity, except, I guess ultimately it's not, right? Because before we even discuss Queensland, I would want them to probably understand something else, which is why do they own their Sydney property? Like, why have you gone and bought this portfolio? What job is it actually doing for you? Has anything fundamentally changed, with that existing portfolio? Or has the media simply changed the conversation around it? And they are very, very, very different questions.
Yes, where assets experience softer conditions, investors should distinguish between short-term market performances and the long-term rationale for that, and for the ownership mainly. Temporary price movements do not necessarily indicate an investment thesis. You need to focus on the underlying reasoning for holding an asset, right? Whether it remains an important part of the assessment.
Yeah, look, because, ultimately, good investors don't replace strategy with sentiment, right? If the original investment thesis, ultimately still holds, the reason why I purchased this property in the first place, was it the capital growth gain that I was chasing, or was it a yield that I was looking for, or was I trying to unlock equity? But whatever that whole reason why I purchased that first property, if that still holds, then, maybe the question is not whether or not I should sell, but perhaps how does this asset still support my stage of my current portfolio?
Yeah.
So, let's have a look at, maybe a third investor for a minute. And, they might actually be facing a bit more of a time-sensitive decision, Maybe they've established a self-managed super fund and they've always intended to utilize that to maybe purchase, a residential investment property, and now everything's changed. And my response to that would be very, very simple. Do not rush into buying a property. Rush into understanding your structure. Structure has to come first before property, and they are completely different things. Because, if your structure is not ready, then ultimately the property doesn't matter. And you should never be rushing ahead to get that property ahead of structure and strategy.
Yeah, the timing consideration for SMSF investors relates primarily to the legislation framework and surrounding limited resources borrowing arrangement. And that creates a defined planning window. And however, planning should never be confused with the urgency to acquire another property, or which is not good quality.
Yeah, look, exactly. And I think we've said this before, and I think it's worth repeating, that a deadline does not improve a bad investment, right? It simply just creates a deadline. But good property backed by good structure, good advice, right? Those are the things that really matter when it comes to creating a portfolio. And, ultimately they always will, right? But, did you notice something? We've spoken about, 3 investors, the same week, same headlines, same legislation, operating, I guess, in the same environment, but 3 very different conversations. And ultimately that's divergence, not just in markets, but also in decision-making process. And that's why, trying to solve investment decisions with one national headline really works when it comes to building a portfolio. So if this episode has reinforced, one idea, I really hope it's this. Do not ask what the market is doing, but ask what the market means for my portfolio. And then that's the question that sophisticators will ask when it comes to determining what it is that I'm actually trying to do next, because markets don't create wealth. Disciplined decisions ultimately do. And that brings us probably for me to one final thought, because I think that there is one question that every single investor should be asking themselves before they make another move.